In recent weeks, a number of media commentators have criticised Donald Trump's One Big Beautiful Bill on the basis of a statement by the Congressional Budget Office that under existing legislation, the bill adds $3.4 trillion to the US budget deficit. They tend not to mention that this is because the existing law assumes that all of the tax cuts made in 2017 in the first Trump administration expire at the end of this year. Let us look at what might have happened in January 2026 if the cuts in the US corporate tax rate in Trump's first term were not renewed and extended in the One Big Beautiful Bill. Back in 2016, before the first Trump administration came to office, the US corporate tax rate was then 35%. In 2017, the Tax Cut and Jobs Act reduced the corporate tax rate to 21%. But because this bill was passed as a reconciliation bill, this meant that it required only a simple majority of the Senate votes to pass. Unfortunately, this tax rate of 21% was due to expire in January 2026. The One Big Beautiful Bill made the expiring tax cuts permanent. This bill was signed into law on the 4th of July 2025. Now, of course, the same legislation also made a large number of individual tax cuts in the original 27 bill also permanent. Now, what would have happened if the bill had not passed? Let's construct what economists call a counterfactual. Let's just restrict ourselves to the case of what would happen in 2026 if the US corporate tax rate had risen to the prior rate of 35%. This was an increase in the corporate tax rate, would be an increase in the corporate tax rate of 14%. This increase would suddenly generate a fall in US corporate after-tax earnings in January 2026 of 14%. What effect would that have on the level of the S&P 500? Now, the price earnings ratio of the S&P 500 in July 2025 was 26.1. Still, the 10-year price earnings ratio for the S&P 500 is only 18.19. Okay, let's say 19 times. Should earnings per share have fallen suddenly by 14%, then the S&P 500 might have fallen by 14% multiplied by the short-term price earnings ratio. This would have meant a likely fall in the S&P 500 of 37% in the beginning of 2026. As the market recovered to long-term price earnings ratio of 19, this fall might have been reduced to a decline of only 27%. Put simply, had the One Big Beautiful Bill not passed, then in 2026, the US stock market might suddenly have fallen by 37% before recovering to a fall of 27%. The devastating effect on the US and indeed world economy might possibly have caused a major recession. On 9 June, Kevin Hassett, the director of the National Economic Council, said in a CBS interview with Margaret Brennan that if the bill did not pass, US GDP would fall by 4% and 6 to 7 million American workers would lose their jobs. The passage of the One Big Beautiful Bill on the 4th of July thus avoided one big ugly disaster.